Hello, it's Jeffrey Christian of CPM Group. We're recording this around 4:30 on Monday, the 20th of November. We'll release it on the 24th of November, Friday, but we won't be in the office that day, so we're recording it earlier. I want to talk about investment demand trends. We've shown you this gold price, and the reality is that gold prices on an annual average basis have set consecutive records in 2020, 2021, 2022, and will do so again by a wide margin in 2023. So you're seeing very high gold prices. And as we've talked about for decades, it's really net investment demand of physical gold or that determines the long-term trends and levels of gold prices. Futures and options have a great amount of influence on short-term, intraday, 1 day, 1 week price trends, but the futures market actually keys off of the physical market. That's something that if you're in the core market and you've been in the core market for decades, as we have, you know and you see it. There's empirical evidence day in, day out, year in, year out. If you're a casual observer who wants to believe in conspiracy theories, you'll say that the futures control the physical market price. That's not true on a long-term basis. It's the long-term supply-demand fundamentals that determine long-term gold prices. And the single most important supply-demand factor is investment demand trends, which is one of the reasons why good economists separate investment demand from industrial demand or fabrication demand, because you really want to look at it as quite distinct. Fabricators have to use their gold. They're in the business of making jewelry or electronics or decorative items or plating razors or plating pens, and they need to buy gold to meet the demand for their products. So they're kind of captive buyers. Obviously, they can change their levels of demand somewhat, but investors are free to come or go or not even be involved in gold completely. So they have total discretion, and they have a lot more money to put to gold or to take away from gold than fabricators or mining companies or other participants in the gold market. So it really comes down to investment demand to determine whether gold prices are rising or falling. Now, this is a chart of net investment demand for physical gold since 1966. And you can see that with the black bars, those are years in which investors bought more than 20 million ounces of gold, more or less, in most of those years. And that corresponded with rising prices. In the lighter blue years, they bought less than 20 million ounces, and that tended to correspond with flat to lower prices. And you can see 3 red dot bars. Those are the 3 years in which investors were net sellers of gold by very small amounts. And the biggest one, which was, about 14, 15 million ounces, was back in 1970, after the price had gone from $35 to $68. It's this investment demand that really drives gold. You can see in 2020, investment demand shot way up. It had been like 17 million ounces in 2018 and 2019, kind of a bear market. The price was kind of flat to started rising in the second half in July of 2019. 2020 saw the pandemic and the global economic lockdown, and investors bought almost 40 million ounces of gold on a net basis, and the price shot up to record levels. In 2021, we were coming out of the lockdown. COVID was coming out of getting under control. Vaccines started being rolled out in the first quarter of 2021. The economy actually, on a global basis, responded very strongly to coming out of the lockdown. And investors were still worried about a whole lot of stuff, but they were less worried than they had been in 2020. They bought about 24, 25 million ounces of gold, enough to keep the price high, enough to keep the price at record levels on an annual basis, moving actually a little bit higher, to about $17.99 on an annual average basis in 2021. But not so much as to continue to drive the price higher, significantly higher. In 2022, investors bought about 26 million ounces, and this year they're buying about 25 million ounces, a little bit less than they had bought last year. And that's being reflected in the price still staying very high, moving to new high levels because this is above 20 million ounces. In gold, net investment demand of physical gold above 20 million ounces historically has correlated or corresponded with high and rising gold prices. And that's what we've been seeing over the last couple of years. Now, there's been some moderation. There was a very strong demand in the first quarter. Second quarter and third quarter saw less strong demand. And then you're starting to see it pick up a little bit since October, since early October. So it's just one component of investment demand. Physical backed gold ETFs. And you can see really for the last 3 years, we've seen small amounts, 5 to 10 million ounces per year of net redemptions of those ETFs. Some of that represents profit taking at record levels. Some of it represents investors thinking that the prices have peaked and that the bulk of the increase has happened. Some of it represents investors saying, I'd rather have physical gold than a share in an offshore company that holds gold as its sole asset that cannot readily be redeemed or cost effectively be redeemed for physical gold. Most ETFs, if you wanted physical gold instead of the share in an offshore company, the sole asset of which is gold, you have to sell those shares, pay your commissions and fees on that sale of those shares, and then take your proceeds and buy physical gold, oftentimes from somebody other than the person that the company that you've just sold the shares to, because a lot of companies that trade shares don't trade physical gold. And then you have to worry about what kind of premiums you're going to be charged from both sides of the transactions. So part of what we've seen over the last 3 years is some investors, because of ongoing concerns about financial market stability, government stability, political and economic risks, have actually shifted away from ETF holdings to physical gold that they actually possess. So that's one of the factors to pay attention to. I just wanted to bring that up. It's very important to understand this is what's really driving gold. Not so much the ETF trades, because that's a small portion of the amount of gold that's actually held by investors. But overall demand from investors for physical gold, including ETFs that have backing of gold, because that does represent investment demand for physical gold, typically on an allocated basis. So it's really that physical demand for gold from investors that determine whether prices rise or fall. And if you know what our projections for gold prices have been over the next couple of years, you know that we think this is going higher 2024, 2025, rather than lower. It's really all I have right now. Have a good weekend. Take care of yourself and those around you. Try to do something good for the world. And we'll talk to you next week. In the meantime, if you want, you can become a CPM Group client and get the 2 big market alerts that we did. Well, they're not big. They're 7 and 9 pages. So you can read them easily on a weekend. You can go to www.cpmgroup.com, or you can send us an email at info@cpmgroup.com and say you want to sign up and be a client and receive those market alerts, among other services that we provide our clients. Also, on the 6th of December, we will be hosting an open forum online where investors can either send in questions ahead of time or they can ask questions during the forum. And it's an open thing. We have no presentation per se. We're there to address the issues that our clients want us to address. So those two things are available to CPM Group clients coming up over the next couple of weeks. You can go to our website, read about our research, see a bunch of free reads, watch videos, and determine what it is that we can do best to serve you. That's all I have for now. Take care.